Hey everybody, Brian here. Today is Wednesday the 23rd. This is the presentation I did at Stocktoberfest in Coronado yesterday, and I wanted to make sure that you guys had the opportunity to see what I presented and not feel like you're missing out as you are a paying subscriber to Alpha Trends. That wouldn't be fair to you. So the title of it was Secrets from 33 Years of Trading. And, as I say, there are no secrets, just guidelines, lessons, and things that we can do. This was me actually in 1990. I think we went there for a college trip to the New York Stock Exchange. You guys have seen me now. I don't have hair like that. I'm not saying that's what this business does to you. I think it might have been genetic, but either way, a lot more hair back then when the S&P was trading at just 389, today up at 5,800 and change. A nice 1,398% gain, but today we see stocks do that in a day sometimes. It's kind of insane the way the markets have changed in that regard, that they've gotten so much faster. When I started, we were, it was the SOS days, and stocks were trading in really in quarter points for a lot of them. And some stocks were in eighths, which was, you just got good at doing math. 1/8 is 12.5 cents, 3/8, 37.5, etc. And the bottom line was that, we then went, well, not the bottom line, but we then went to sixteenths or teenies, and that was 6.25 cents per tick. So right now we have penny spreads. We've got much deeper pools of liquidity, and, have things gotten better or they're just different? I don't think they're better or worse. They have evolved, and here, this is the market we have today. As you know, I always think the best way to approach it is through simplicity. That I was told, first I heard the quote that simplicity is the market's greatest disguise. And I believe that to be the absolute truth. You see people all the time trying to add different formulas. As I say, I use simple moving averages. I can figure them out in my head. Everyone wants to be different and think that the EMA is faster and gives better signals. It simply does not. Put a simple and an exponential moving average on your chart, and look, sometimes it'll be the EMA and you'll say, see, I knew it. And sometimes it'll help right at the simple moving average instead. The bottom line is they are not action points. They're reference points, something to give us a idea of who's in control or where that battle is being formed. And I'll just say very quickly, for the 5-day moving average, the simple is better. I have seen it on thousands of charts. I still have it on there today, the simple and the EMA. And the EMA will give you signals way earlier than you should be getting a signal. So keep using EMAs if you think it's gonna do better for you. I'm not gonna tell you you're wrong, but you are. Anyways, simple works, and what I see all the time. And, people will say, hey, Brian, what's the formula for the simple moving average? And of course I lose my patience, because that's not somebody who is going to succeed in the market. If you're asking simple questions like that, and if you can't go out there and figure out some of this stuff for yourself, how are you ever going to compete with people who are critical thinkers, who are out there trying to figure things out for themselves and learn new techniques and hone their craft? So you have to be a critical thinker. And I put a tweet out today. I forgot what it was. It was a seasonality thing, and people thought it was for the month of October. And if you just read the title was Seasonality for September. And here is today, October 23rd. And one person looked at it. I got a bunch of likes, and one person said, hey, wait a minute, this is for October. And I said, exactly. That's, the point wasn't whether we're doing this today, but to look at seasonality the same way I talk about a VWAP. A VWAP is, or any other potential support area, is simply a level of interest. It's where we want to look for the potential that buyers are going to gain control on a pullback. Seasonality, or time of year, is a time of interest. Seasonally, it might be weak at a certain time of year, but if the market is going higher, what are you going to believe? Are you going to believe seasonalities and averages, or are you going to believe what's happening right in front of you? So think critically. double check things. Only price pays. We know that. You've heard me say it a bazillion times. But you've got to learn to listen to price action. I say it all the time that, I honestly don't read any news stories about stocks or the economy. I don't read any news stories. I get bored after 2 sentences. Mainly why? Because, they're going to plant a thought in your head that Fed slashes interest rates by 0.5 point, an aggressive start to the first easing in 4 years. And, we were supposed to be cutting, I think, 300 basis points this year. Now they're saying it's probably going to be less than 100. So nobody knows the future. And especially the people who are writing articles for CNBC, for Forbes, or whoever. I'm sure they're all well-intended, but their job is to sell news stories, to get clicks, to get ad impressions. That's how they get paid. So they have to make it sound like they know what they're talking about. But when the Fed cut rates, that was on September 17th, just a little bit more than a month ago. The 10-year bond yield was at 3.6%. The 10-year bond yield is important because that's basically, the rates that we use. It's not what the Federal Reserve and large banks pay. That's what they're cutting is that interest rate, the Fed funds rate. That's got nothing to do with real interest rates. Real interest rates went from 3.6% on the day that they were cut to 4.2%. So the Fed cut interest rates by 50 basis points, but the market's calling bullshit on it and saying, we don't think things are as rosy as you think they are, so we're raising interest rates by 50 basis points. Buy the rumor, sell the news. So listen to price action, not the news. You would look at it and say, and I remember, talking to my wife, we had the nightly news on, and like 2 nights after that, and they're saying interest rates are already, mortgage rates are already coming down. And I looked at it and I said, that's complete bullshit. That is just not true, because the 10-year rates were rallying, and interest rates on mortgages are higher than they were on the day that the Federal Reserve cut rates. So you can't listen to the news. Listen to price action. Only price pays. Another thing we hear, is these theoretical relationships. And over time, over the long term, if gold is going up, it's typically during a weak dollar period, and vice versa. So when we see the opposite happen, or when they move in lockstep, like they were just recently, we saw, this is the beginning of September, and the dollar index was at 101. Well, here we are a little more than a month later. The dollar index is at 103.40. Gold at the same time was at 230 GLD, and here it is at 252. So they're both trending together. Not perfect, but over here in lockstep, and that's not supposed to happen. So you have all these hedge funds that say, one of these is wrong, so they're going to short gold because the dollar is going up. Well, guess what? If you're short gold, you're losing money. You're betting on a tendency, not on what's actually happening. It doesn't mean they might not come back into alignment, but meanwhile, if you're fighting this and you're short gold at 241 and it's at 251 in the course of 2 weeks, unless you're trading tiny amounts, then this is a significant loss. When I make a bet, I like to make it a significant bet. I would not accept this type of risk. People who accept this type of risk are not, in my opinion, really good traders. Another thing that just that is out there is that people always think you need to buy the low. And that's just so far from the truth, which is why I always say don't buy the dip. Buy strength after the dip. When the NASDAQ peaked in 2021, it started to decline, lower highs, lower lows. The anchor off of that, we saw sellers appear over and over again. And then we saw some higher lows, and some people were calling this right here the low. Some people called this the low, and this was the absolute low. And maybe a couple people even said, hey, this is the low. Well, congratulations. Great. You get a medal pinned on your chest for calling the low. The bottom line, what we're looking for is, where does it make sense to participate, where we have the wind at our back and we can manage risk. So we saw We were still stuck under the average price from there. The average participant from the 2021 high on the long side didn't make money until this bar right here a year and a half later. The average short seller started to say, wait a minute, things are going against me a little bit. And there was a little battle in there for several weeks. And then the buyers took control, and look at this beautiful uptrend. Let's say you bought it in your investment account right here. You don't need to own it at 260. Owning it at 310 is good enough because you're closing in on a double now. Not quite a double, let's say 75%. You don't have to buy the lows to make money. Sure, it's gratifying from an ego standpoint to be able to say you bought the low. And the point is here that if you buy there, where does your stop go? It's the same things I harp on all the time. This might as well be a 15-day chart with a 5-day moving average on there. It's all the same concepts. We don't buy the dip. We buy strength after the dip, and then we participate on the time frame that we are comfortable with and manage risk. You don't have to buy at the low to make money. Big money is not smart money. How many times have you heard me make fun of the manager of the ARK fund? The ARK fund still, to this day, you just can't. If you type in the name of the manager, you'll see there's probably 3 or 4 headlines about this person today. They act for whatever reason like this person's doing a good job. Since the inception of the ARK fund in 2014, a 10-year track record, their fund, their actively managed fund, has gained 157%. At the same time, had you bought the S&P 500 fund, the SPY, you'd be up 245%, and a passive investment. If you were looking at a little bit more high-octane stocks, like some of the ones in the ARK fund, you'd be up 430%. What if you were just involved in the semiconductors? You'd be up 1,000%. This is terrible. Stop looking at big institutions and thinking that they get things right all the time. I always hear people saying, oh, the market makers are doing this. Oh, the institutions are trying to shake people out. Institutions are not that smart. They're just the same as individuals. By that I mean most of them don't outperform the market. There's been studies out there in any given year, 80% or so of all actively managed funds fail to beat the S&P 500. For actively managed funds to beat the S&P 500 2 years in a row, instead of 80%, it drops down to about 96% of them fail to outperform. So big money is not smart money. Just follow price action. Forget about what everyone else is doing. That's why we focus on the cyclical nature of the way money moves through the market on every single time frame. As you know, and I show it all the time, this can be a 1-minute chart that starts at 9:30 a.m. and ends at 4 p.m. And if we drew a VWAP in here, it would look like this, and the sellers would start to battle in here, and they take control in the afternoon. This might also be a stock that, like Occidental Petroleum, we'll talk about here in a minute, that is a 5-year chart. But when it's in the decline, you basically you don't want to be a buyer. You let other people do the buying. Sure, you can make money on these bounces in here, but the sum of the declines is greater than the sum of the rallies during bearish periods. Now, this is the S&P 500 through, I think I captured this maybe Tuesday morning because I'm always doing my presentations last minute. So this was through maybe yesterday morning, and this goes back to mid-August. And as I always point out with this color shading, it's not meant to be a buy-sell signal. If you're looking at it as a buy-sell signal, you're looking at absolutely wrong. We always have to consider other pieces of the puzzle. But if it's making higher highs and higher lows, that means the sum of the rallies is greater than the sum of the declines. Can you make money shorting here? Yeah. But you're fighting the trend. News and surprises tend to follow the direction of the trend. And you have less opportunity to make money on the short side because that's just the math. It rallies 10 points, pulls back 3. Rallies 5 points, pulls back 2. The sum of the rallies is greater than the sum of the declines. You've got momentum. Why do people fight this? I don't understand. Why do you buy these pullbacks? It makes no sense. So listen to the message of the market. And in here, again, these are the four stages. And this is Occidental Petroleum from early 2000. We were in a downtrend. It started to turn sideways. We had moving averages crisscrossing. And then we saw a higher high above the flat to rising 200-day moving average, 42-week right in here. And then it was an uptrend. And where did we start hearing about Warren Buffett's heavy buying? It was really, if you look back at the headlines, most of his big buying was in this distribution. Now, we didn't know it was distribution until it broke support. When it broke support, then we say, okay, that was distribution. If it instead rallied from here, we'd say that was a pause. Buffett had it right. But guess what? Someone's selling. Buffett might own 20%, 30%, but someone's selling to him. And their sales are more aggressive, and he is now in a losing position in this. Yes, we can get bounces from 50 to 55, nice 10% rallies. Is it worth it? Is it worth the brain damage of trying to pick the bottom over and over again and get a rally once in a while? I look at this stock and I have zero interest in it. It's in a downtrend. It's guilty till proven innocent. If we expect a rally to sustain itself, it's going to have to get back above 56 and hold above there just to become neutral. This might end up being a big bear trap. And if you're not an institution, even an institution shouldn't be accumulating in here because it might do another one of these declines. An institution should be accumulating in here and then selling some as it rallies, buying a little bit back as it pulls back over and over again and managing their position. But no one gets it right all the time. It doesn't, Warren Buffett's time frame, by the time, Berkshire sells this, Warren will be long gone. It's got nothing to do with his lifetime. It's positioned for well beyond his expiration date. So we talk about the trend, and the trend is your friend. And which trend is your friend? Are we enthralled with the daily chart of the biotechs here with it above the rising 200-day moving average? If you're an investor, well then, and you don't want to listen to the blips, then great. Stay long this as long as we're making higher lows above that rising 200-day moving average, but we're not making higher highs. So we're just kind of biding time here. And on the 15-minute time frame, we traded it over here. We sold a third here. We sold a third here, and we got out of the rest over here, if you recall. Didn't buy it all the way down. And I didn't buy it here. I missed it. Maybe I should have. But as I mentioned, on this day and this day, I had zero FOMO because I figured it's likely to pull back again. And it has pulled back. And, I got a question in Discord yesterday, and it doesn't matter who or what, but we don't buy, saying, is the biotech a buy right now? And the absolute answer is no, it's below a declining 5-day moving average. What if we're right here and you're trying to buy it and you don't know all that is coming? You're trying to buy it at 99.5 because it's down from 103. That seems like it's down too much, but it goes down to 95.5. Do you really want to put yourself in a position of weakness where you're down 5 points like that so quickly? It's completely unnecessary. Buy strength after the dip. Sometimes you're going to miss those trades, and you've got to be okay with it. You've got to say, I don't care. I'm not going to break my discipline. Or are you going to drill down to shorter term time frames than a 15-minute time frame and say, hey, if I can get a good day trade entry at 9:30 in the morning and buy it, let's say right here at 99 with a stop of 98.30, well then, great. I'll sell half of it that day because it's a little bit extended, and I'll raise my stop up and maybe get stopped out over here for a small win. But wait, buy strength after the dip. What we're looking for is trend alignment because we have the longer term innocent till proven guilty above a rising 200-day moving average. We want to be a buyer over here. Yes, you can make money shorting over here, but these little pullbacks, the sum of those is less than the sum of the rallies. Now, maybe not this time. Maybe it's going to fail in here. Maybe it's just going to be, biotechs didn't have the juice to do it. Well, I'm not going to find out through losses. I'm going to find out by sitting on the sidelines and avoiding the pullback until the market tells me, hey, maybe you should get involved because it's starting to round out again. It's back above the 5-day moving average. And if I can get involved at a low risk, high probability place, what do? We look at it and say, we're looking at the stock or the XBI or whatever it is, and we're saying, where has it come from? If it just rallied, if the biotechs just rallied from 95 to 98, I personally don't want to buy it. I want to see a little pullback. And maybe I miss it. Fine. I don't care. I truly don't care. Where does it have the potential to go before it can find some supply? And maybe there's an anchor from a prior level. And you say, okay, well, it's rallied 3 points, but I love this trade, so I'm going to buy a half of a risk unit. Play with your risk size. Don't always just think you have to be in all at once or not. So if you answer where has it come from, and it's had a little bit of a rally, and 3% is a little bit of a rally. It might go 20%, and you might look at it after and say, I should have bought it there, woulda, coulda, shoulda, etc. That's not the way a professional looks at the market. The professional looks at the market and says, I have a strategy, I have an approach. I'm not going to win every single time. I'm going to miss a lot of trades, and I'm probably going to fat finger and mess up some trades. But overall, if I stick with a strategy where I'm not chasing things, and that's the biggest mistake I see individual traders make, is chasing things that have already moved. And people always say, well, what is chasing? Is it because it's up 3%, 5%, 10%? Look at the personality of the stock. Is it running into a potential level of supply that might become resistance, a prior band of support? Is it at a Fibonacci level? Is it some of these basic things that we talk about? And, sometimes you look at it and you miss a trade and you regret it a little bit. But, and that's human nature. It happens. But as I repeated over and over again the last couple of weeks, as it was rallying, I said, I have zero FOMO, none whatsoever. I simply have said it. I do not care that I've missed this rally because I'm going to wait for it. I'm not going to break my discipline. My discipline is more important than making every single trade in hindsight and saying I should have, would have, could have done this. Engage when you have the odds in your favor. And if you look at it and say, hey, I really like the biotechs, it's rallied 3%, well, that's why we talk about risk units. One risk unit is maybe $1,000 for you. That's your maximum risk. Well, if you look at it and say it's already expended a little bit of energy, and let's say it's halfway to the price target, that might be a way you want to do it. If it's halfway to what you think is, the prior breakout point, it's not really a price target, but the prior breakout point, if it's halfway to that, then you say, okay, well, I'll do a half a risk unit. I'm only going to risk $500 buying it up in here, and understanding that, bet size is something that you have control over, and that you can look at it and, decide, have a little bit of discretion over the trade. So just don't chase. And again, it's always people want a formula. Is it this ATR? Sometimes it's just eyeballing the stock and saying, look at the personality of the stock. Typically it rallies 6%, and that's why I point out all the time. And it's not about rules, it's guidelines, but that's the point of the videos all the time, is to show you, here's how it is with this stock today. Last week, we looked at a different stock that had a different personality. So we look at that and say, here's how we handle it with that stock. They're all different, but the concepts are the same. Not the rules, but the concepts, the guidelines are the same. And once we've determined that, yes, it does make sense for an entry, we're not chasing it, then we say, well, where does it have the potential that it can go before it might find supply? That tells us our potential for reward. Theoretical. It's always garbage in, garbage out. It doesn't matter what we think the price target is. We might buy it at 99 and say our price target is 120, but then the stock pulls back and hits our stop at 98. Our profit zone meant nothing, or that's why I don't do price targets. It's about risk management. When you're in a trade, you raise your stop up underneath the higher lows, and hopefully that rally will continue as long as possible. But when it starts to break down, you listen to the message of the stock and you sell over here. You sell over here if you're long. You avoid this over here. You avoid buying the dip. It's about having a consistent methodology that you can engage in the market on any time frame. Alpha Trends is about swing trades. Everything I talk about is about swing trades. That's my expertise. That's what I'm good at. Sometimes I'll point out stocks and say, hey, if you're an investor, maybe you want to get involved in this with a different stock. Stop. Go do your homework, whatever you need to do fundamentally to figure this out. But Alpha Trends is a swing trade service. If you want to day trade them, well, then you don't look at a daily chart and a 15-minute chart. You can to get the idea, but if you want to day trade it, well, then you look at a 1-minute chart, a 2-minute chart, maybe even a 5-minute chart. Start to drill down on different time frames. Risk management, as I say it, and I've been more aggressive in the last year about this because I see so many people doing so many stupid things with their money. A lot of people talk about risk management. How many people do you follow on Twitter where every single trade they mention has a stop? Go look at the people you follow on Twitter. Do they mention a stop? I make it clear. This is my risk. This is my stop. This is my worst case stop. Go make the trade your own is what I always say. I don't pay lip service to it. And, so the thing to risk management, that is, and sometimes people will say, hey, Brian, a month ago you said you liked XYZ at 25 and here it is at 23. Do you still like it? And I'll go back and I'll look at the tweet and I'll say, you saw that I liked it at 25. Did you see that I said that my stop would be at $24.37? You're on your own here. This is your idea. I'm not here to tell people what to do. I'm here to give you guidance and to give you a way of looking at the market consistently, a methodology so you can look at the market and have the confidence that you're not just throwing darts. You're not just listening to the news and rumors about what Warren Buffett is doing or what the Federal Reserve is doing and, hey, maybe I should go buy bonds because the Federal Reserve is cutting rates or go refinance my house. No, that's not the way it works. Only price pays. Manage risk obsessively. I'm going to end it here. This actually went about twice as long because I had a more relaxed pace. They only gave me 15 minutes at Stocktoberfest. So anyways, hope you enjoyed it and learned something. Thanks.